Good morning, everyone. We are from Group Freddy Cosado, and today we will be presenting on accounting for provision, contingent liabilities, and contingent asset under MFRS 137. My name is Wang Yimun, and I will start with the introduction. What is MFRS 137? It is a standard issued by the Malaysian Accounting Standard Board. It provides guidelines on how companies should account for provision, contingent liabilities, and contingent assets. It focuses on three main areas, which are recognition, measurement, and disclosure. The main objective is to ensure that financial statements present a true and fair view. Why it is important? Because it ensures accuracy in financial reporting. It helps to prevent manipulation of financial statements such as understating liabilities and overstating assets. It also provides clear rules for handling uncertainty, improve transparency, and allow users like investors and creditors to make better decisions. And this standard covers items that involve uncertainty. It includes provision, contingent liabilities, and contingent assets. It applies when outcomes depend on future events. It also requires a company to recognize valid obligation and disclose uncertain items properly. Now I will pass to Chi-En to explain provision.
Thank you, Imun. Building on that, I will now explain provision. Under MFRS 137, a provision is a liability of uncertain timing or amount arising from past event. This means the company already have an obligation, but we are not sure when or how much need to be paid. For a provision to be recognized, three criteria must be met. First, there must be a present obligation. Second, there is a probable outflow of economic benefit, which means more than 50% change. Third, the amount can be reliably estimated. If all these conditions are met, the company will recognize a provision in the financial statement. Next, I will explain how provisions are measured. Provisions are measured at the best estimate of the amount required to settle the obligation. There are two main mentioned. First is the expected value mentioned, which is used when there are many possible outcomes. Second is the most likely outcome mentioned, which is used when there is one main outcome. If the time value of money is significant, discounting will be applied. Example of provision include warranty obligation, legal obligation, and environmental liability. That's all from me, thank you. Now I will pass to Peng Peng to continue with the next part.
Contingent liability. The definition is a contingent liability refers to a possible obligation that arises from past event, but its extent will only be confirmed by uncreated future event. This means the company is not sure whether the obligation will actually happen or not. In some cases, it can also be a person obligation, but it is not recognizing because it does not meet the criteria such as probability or reliable measurement. And when do disclose, the contingent liability are not recording in the financial statement because during some main usual. Instead, they are disclosed in the note to the financial statement. However, if the probability of outflow is very low or small, this not disclosure is recorded in. Why not recognizing? The means resource contingent liability are not recording is to avoid misleading financial statement. If compared recording uncreated obligation, it may overstate liability and reduce reliability. Also, in the many cases, the amount cannot be measured reliable, which violate the recognition criteria under MFRS 137. In the example, the common example is ledger disputed. If company is be sure and the outcome is uncredited, it will disclose it as a contingent liability interest of recognizing it. Another example is when a company grants and the debit of debt of another party. If the other party failed to pay, the company may need to settle the debt.
First, let's look at definition of a contingent asset. Contingent asset is a possible asset that arises from past events and its existence will only be confirmed by uncertain future events that are not fully within the control of the entity. These assets are usually related to situations such as legal claims, compensation, or insurance recoveries. Next, let's move on to the recognition rules. MFRS 137 applies a conservative approach when dealing with contingent assets. If the inflow of economic benefit is probable, the asset is not recognized, but it is disclosed in the notes. However, if the inflow becomes mutually certain, then the asset can be recognized in the financial statement. Here are some examples. First, legal claims. This refers to a situation when a company suing another entity may receive compensation if the case is successful. Next, insurance claims. The involves a situation where a company expecting reimbursement from an insurance company may have a contingent asset. Now, let's compare this with other related items. A provision is a present obligation. It is recognized in the financial statement because it is probable and can be variable measure. It also requires measurable, which is based on the best estimate, and it is disclosed in the notes. In contrast, a contingent liability is a possible obligation. It is not recognized in the financial statement because the outflow is not probable or cannot be measured. Therefore, no measurement is required, but it is disclosed in the notes unless the possibility is remote. Similarly, a contingent asset is a possible asset. It is not recognized, but the inflow of economic benefit is uncertain. No measurement is required, but it is disclosed when the inflow is probable. It is only recognized when it becomes mutually certain. To conclude, this comparison theory shows that provision involve recognition, measurement, and disclosure, as they are probable, while contingent items mainly involve disclosure due to their uncertainty.
In conclusion, MFRS 137 ensures proper accounting for provision, contingent liabilities, and contingent assets. Provisions are recognized when obligations are probable and measurable, while contingent liabilities and assets are only disclosed when necessary. This standard improves the accuracy, reliability, and transparency of financial statements.